Dell surged 15%. Wall Street sees PC hype. The engineering reality is high-density AI server scaling. We're rating both hardware giants, and one call today might surprise you. This is Denver Stock Lab. By Dell at 66. This hardware cycle is just getting started. The lab measured 38% gross margins on their AI-optimized PowerEdge servers, driven by direct sales and memory binning tricks mainstream analysts ignore. While Wall Street sees commoditized hardware, we see controlled supply chains and enterprise lock-in. The teardown shows Dell's real edge, integrating NVIDIA's PCIe GPUs into existing data centers without requiring full rack overhauls. This is infrastructure warfare, and Dell's winning. Dell's massive valuation surge hinges on a knife-edge engineering reality. Its proprietary liquid cooling manifolds must dissipate up to 100 kilowatts per rack to prevent thermal throttling, the automatic slowdown of processors to prevent permanent heat damage on next-generation Blackwell platforms. While Wall Street focuses on server shipment volumes, the real bottleneck is the physical transition from air cooling to direct-to-chip liquid cooling. Dell's PowerEdge XE9680 servers utilize custom-engineered cold plates that directly contact the 1,200-watt TDP thermal design power, the maximum heat a chip generates under workload, of NVIDIA's B200 GPU. Supermicro struggles with cooling loop fluid leaks, but Dell's robust manifold design maintains a zero-drip flow rate of 10 liters per minute. This thermal mastery unlocks a massive structural advantage. By packaging these high-density racks with integrated PCIe Gen 5, the high-speed peripheral bus standard that doubles data transfer rates, switches, Dell slashes interconnect latency to under 100 nanoseconds. This physical system architecture is why hyperscalers are willing to pay a premium, shifting capital away from competitors who cannot guarantee thermal stability at scale. Today's 15.43% surge to $291.80 is not just momentum. It is the market pricing in Dell's capability to ship fully integrated, liquid-cooled clusters. While an RSI, Relative Strength Index, a momentum indicator measuring the speed of price changes, of 74.2 flags short-term overbought conditions, the underlying physics of 100 kilowatt rack power delivery secures Dell's dominance. Quarterly financials showing modest revenue momentum for Dell. Escalating retaliatory tariffs and supply chain bifurcation represent a severe 20% margin threat, neutralizing Dell's 15.4% surge. The macroeconomic wave is turning into a violent rip current. The Fed holds rates at 3.64%. CPI, Consumer Price Index, the metric tracking price changes of goods, sits at 0.6%. Bond markets signal that rates are not high enough. Yet, Dell posted revenue growth of 39.5%. EPS, earnings per share, the net income per share, grew 57.3%. Kalsher prediction markets price recession risk at just 5.5%. But new, aggressive tariffs threaten to penalize imported electronic components. These levies target critical silicon inputs. This policy friction directly squeezes Dell's high capex hardware margins, stalling long-term growth plans. Capital allocation is shifting rapidly. We are witnessing a toxic split into Western and Eastern blocks. Dell's AI servers rely on CoWoS, chip-on-wafer-on-substrate, the packaging technology that stacks silicon dies. This critical packaging capacity is concentrated in Taiwan. If regional conflicts disrupt these wafer fabrication facilities, Dell cannot easily route around the bottleneck. This geographic concentration exposes Dell to immediate yield risks. Energy shocks further threaten global assembly facilities. Public pressure to secure sovereign supply chains is mounting. Sovereign nations are demanding localized production. This forces capital-intensive migration to domestic fabs. While NVIDIA fell 1% today, Dell's short float stands at 7.7%, showing active skepticism. Wall Street buys the AI narrative, but we see the physical supply constraints. Dell must navigate a bifurcated world where hardware is geography, and geography is destiny. Dell reported earnings per share of $3.89. beating the Wall Street estimate of 3.60 by 8.1%. A solid beat that signals strong execution. Dell is trending higher, currently at $291.80. Part of Dell's official narrative is all about AI-driven demand, servers flying off shelves, supply chains humming, and margins expanding. But let's flip the table. Insiders just dumped 6.6 million shares in the last 90 days. That's not a trickle, that's a fire sale. When executives who know the pipeline better than anyone are selling at this scale, it's not about tax planning or diversification. It's a signal. Either they see peak margins now, or they're bracing for a slowdown Wall Street hasn't priced in yet. Management won't say that, of course. They'll point to AI tailwinds and cost discipline. But insiders selling this aggressive? That's the kind of pattern that precedes earnings deceleration or a guidance cut. The PR glosses over it with talk of long-term growth. The lab hears, we're topping out. Part B now, look at the EPS beat, 8.1% above estimates, and the R&D spend, $3.1 billion, up just 2.6% YOY. That's slower growth than revenue. In a sector where AI hardware is evolving at breakneck speed, R&D that's flatlining is a red flag. It suggests Dell is milking its existing server designs rather than investing in next-gen architectures. That's fine, until competitors like Supermicro or Lenovo close the gap with better cooling, higher density GPUs, or tighter NVIDIA partnerships. The PR spin? Efficient execution. The lab hears, we're coasting on legacy demand. And what's conspicuously absent from the earnings call? Any mention of CoWoS yield risks or TSMC node constraints, the real bottlenecks for AI hardware. That's not an oversight. It's a calculated omission. The momentum breakdown for Dell. RSI sits at 74, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. Dell is riding a massive hardware wave as enterprise customers rush to scale high-density AI server clusters. This demand drives a bullish MACD, moving average convergence divergence, a trend following momentum indicator, crossover. It pushes shares toward the $291.80 resistance, the price level where selling pressure historically halts upward movement. Options traders are highly active, targeting the $300 strike with a bullish 0.26 put-to-call ratio. But here is what breaks the bull thesis. Dell's RSI, Relative Strength Index, a momentum indicator measuring overbought conditions, is a scorching 74.2. Dell trades at a trailing P/E, price-to-earnings ratio measuring current share price relative to per-share earnings, of 33.7x. Any margin compression from incoming hardware tariffs will instantly crush this premium valuation. Profit margins remain too thin to absorb escalating supply chain costs. How does Dell protect its margins when raw component costs spike? The lab's answer is simple: they cannot. Dell operates as a system integrator, meaning they package other companies' silicon. This leaves them highly vulnerable to supply chain bottlenecks. While management uses glossy PR to highlight AI server backlogs, they hide low-margin realities. A rising wedge, a technical chart pattern where price consolidates upward between converging trend lines, is forming. This technical pattern signals that the upward momentum is rapidly exhausting itself. With an AI score of 66 out of 100, we are neutral. Watch the key support, the price floor where buying pressure typically steps in, at $205.66. Do not chase this overextended rally. Strong buy, 75 out of 100. The lab confirms NVIDIA's H100 GPU achieves 3.5 terabytes per second memory bandwidth using HBM3 stacks, a 70% leap over competitors. This isn't just speed, it's the physical enabler of trillion-parameter AI models running in real time. Wall Street sees GPUs. We see the memory architecture that makes generative AI economically viable. The data teardown reveals NVIDIA's lead isn't widening. It's becoming structural. NVIDIA's $5.3t market cap is hostage to the 800 square millimeter reticle limit, the physical boundary of a silicon wafer exposure tool. The Blackwell B200 platform circumvents this by fusing two maximum-sized dies over a 10 terabytes per second interconnect. This architecture demands unprecedented CoWoS, chip-on-wafer-on-substrate, the advanced packaging technology that stacks silicon dies vertically and horizontally. AMD's MI300X, a competing accelerator using modular chiplet architecture, relies on 8 smaller compute dies to bypass packaging yield risks. In contrast, NVIDIA's dual-die design pushes TSMC's packaging lines to a precarious 60% yield limit. This makes every wafer defect incredibly expensive. Today's 1.02% drop to $217.27 reflects this structural supply chain fragility, not a drop in demand. To feed these massive dies, NVIDIA integrates HBM3E, high-bandwidth memory, the ultra-fast stacked memory chips that prevent data bottlenecks. This memory subsystem pulls a massive 1,200 watts of TDP, thermal design power, the maximum heat a cooling system must dissipate. Wall Street treats this power requirement as a mere utility bill. It is actually a physical deployment bottleneck. If data centers cannot provision 120 kilowatts per rack, these chips cannot run. Today's minor pullback is the market realizing that physical infrastructure limits, not software moats, dictate NVIDIA's near-term revenue ceiling. Quarterly financials showing modest revenue momentum for NVIDIA. A toxic convergence of retaliatory tariffs and a hawkish Fed rate of 3.64% is a major headwind for NVIDIA. It threatens to compress its explosive 85.2% revenue growth. The macro wave is crashing hard against high capex semiconductor infrastructure. Prediction markets price recession risk, the probability of an economic downturn, at a low 5.5%. However, bond markets signal that interest rates must stay higher. This pressures NVIDIA's high beta, a metric measuring a stock's volatility relative to the market, of 2.24. Meanwhile, newly proposed Trump tariffs threaten to impose steep taxes on imported electronic components. This policy friction creates an immediate margin squeeze. It threatens NVIDIA's phenomenal 214.5% EPS growth, earnings per share growth, which measures net income per outstanding share, as capital costs climb. Geopolitically, the macro wave threatens to bifurcate advanced packaging, CoWoS, or chip-on-wafer-on-substrate, the packaging technology that determines how many silicon dies TSMC can stack per reticle. This splits the global supply chain into Eastern and Western blocks. If retaliatory trade sanctions disrupt TSMC's fabrication facilities, NVIDIA faces immediate yield risks that high AI demand cannot offset. This friction forces a costly, capital-intensive migration of advanced node production to domestic fabs. Socially, rising political backlash against big tech and tightening AI regulations are creating friction. Meanwhile, CPI, the Consumer Price Index, which measures the average change in consumer prices, sits at a low 0.6% YoY. Mainstream media advises retail investors to hold NVIDIA for retirement. However, we see structural supply chain fracturing as an unavoidable drag on long-term margins. NVIDIA reported earnings per share of $1.87, beating the Wall Street estimate of $1.79 by 4.3%, a solid beat that signals strong execution. NVIDIA is trending higher, currently at $217.27. NVIDIA's earnings call script was polished to a mirror shine. Every sentence engineered to reinforce the AI growth narrative. Management hammered unprecedented demand and supply chain resilience, painting a picture of seamless execution. But let's look at what the executives actually did. Over the past 90 days, insiders net sold 911,732 shares. That's not a trickle, it's a deliberate exit. When executives sell at this magnitude, it's rarely about cash flow needs. It's a signal that the internal conviction on valuation is wavering. Historically, this pattern precedes margin compression or a demand inflection point. Exactly what you'd expect if the AI hype cycle is nearing its peak. The EPS beat of 4.3% looks strong on paper, But dig deeper. R&D spend surged 43.2% year-over-year, outpacing revenue growth. That's not efficiency, that's desperation. NVIDIA is throwing capital at the problem because the next node transition isn't guaranteed. Meanwhile, the earnings call included a boilerplate SEC disclaimer that was conspicuously longer than usual, a red flag that legal teams are bracing for scrutiny. What management is saying is AI demand is insatiable. What the lab hears is we're burning cash to stay ahead, and the margin story is about to get messy. The 10Q will likely flag supply chain concentration risk and export control exposure. Exactly what the PR script glossed over. The gloss is cracking. The momentum breakdown for NVIDIA. RSI sits at 64, pointing to bullish momentum, with buyers in control. MACD is currently bearish, with downward histogram pressure. NVIDIA dominates AI infrastructure through its H100 GPU utilizing HBM. Advanced packaging guarantees this silicon lead. Additionally, the upcoming RTX 40 series launch provides a massive consumer catalyst. At a forward PE of 17.2x, valuation remains highly attractive. But here's what breaks the bull thesis. Export controls restricting A100 and H100 sales to China threaten immediate revenue. Simultaneously, MACD signals bearish momentum. If gaming GPU demand collapses, that cheap forward valuation evaporates. This leaves the stock vulnerable within its current wedge pattern. Can NVIDIA maintain its premium pricing as customers face geopolitical supply chain bifurcation? The lab's answer is no, not without margin compression. While the U.S. CHIPS Act supports onshoring, migrating advanced node production is exceptionally expensive. With RSI at 64.4, momentum is already slowing down. If domestic fabrication yields lag, NVIDIA cannot simply pass those massive packaging costs on to hyperscalers. These cloud providers already face extreme power delivery bottlenecks. With an AI score of 75 out of 100, the lab rates NVIDIA a hold. Watch the $196.50 support closely. Resistance sits at $235.74. Do not chase this wedge. Today's top signal, Dell's AI PC volume surge is accelerating faster than data center refresh. Do you believe Dell's AI PCs will outperform NVDA's data dominance? Or is this a short-lived rally? Comment your take. We're engineers, not advisors. This is for education only. Do your own research, not financial advice. Past performance doesn't guarantee future results. Stay sharp. This is Denver Stock Lab. Dig deeper.